In previous session, I covered assets side of balance sheet. In this session, let's focus on liability and equity side of Reliance Industries' balance sheet. I will explain. What are the different line items on liabilities side of balance sheet? How to analyze each line item using note to balance sheet. This is a continuation of last session on balance sheet. I will show you balance sheet of Reliance Industries from March 2021 annual report. The liabilities and equity side of balance sheet looks like this. It shows all the liabilities company owes. It also shows shareholders' equity. Liabilities are classified into two distinct categories: non-current liabilities and current liabilities. Non-current liabilities include financial liabilities like long-term borrowings, long-term provisions, deferred tax liabilities, and so on. Non-current liabilities are due after a year or more in future. The next line is current liabilities. It includes short-term financial liabilities, short-term provisions, and so on. Current liabilities are due and payable within 1 year. The next important line on balance sheet is shareholders' equity. It includes equity share capital and other equity. Equity share capital is funds collected by company through IPO process. Other equity includes profit retained by company over the years on balance sheet. This is also called as reserve and surplus. Note to balance sheet helps to further clarify breakup of each line item. You can open company annual report and go to specific note to understand detailed breakup of each type of liabilities and equity. It's time to go into details of each line items on liabilities side of balance sheet. Let's start with non-current liabilities. Balance sheet includes several liabilities reported as non-current liabilities. One of the biggest line item you notice on Reliance balance sheet is borrowings. You can review details of borrowings under Note 15 on annual report. Let me show you details of borrowings from Note 15. It mainly includes loan taken by company to conduct business operation and expansion. Please note this is company's long-term borrowings due in future. The amount of debt listed under Note 15 is reported on balance sheet as borrowings. High amount of borrowing can impact company's future profitability and ability to manage operation during bad economic condition. I generally prefer company with very low or no debt for investing. When company chooses to borrow money, it must pay interest. Let's go back to income statement and recall line item called finance cost. Finance cost refers to the interest and other costs incurred on debt. Higher the debt, higher is the interest and repayment cost listed on income statement. This will reduce company's overall profit as well. Let's review other line items listed under non-current liabilities. You can refer corresponding notes to seek greater clarity on non-current liabilities. Starting with other financial liabilities. It mainly includes company long-term lease liabilities. This lease could be related to use of rented property, plant, equipments, and so on. The next line item is deferred payment liabilities. This records the company liability that is due in future. The next line item is provisions. Provisions represent the money set aside by company to cover anticipated losses in the future. The next line item is deferred tax liabilities. Deferred tax liability is the estimated income tax payable in future. Deferred tax liability can arise due to tax relief claimed in advance on expenses as well. It can also arise due to sale is done on credit and tax is not due until payment is received. The last line item is other non-current liabilities. Any other liabilities that are not classified under previously discussed categories are classified as non-current liabilities. Now, it's time to review current liabilities and understand how it is recorded on balance sheet. Current liabilities are a company's obligations which are expected to be settled within a year. The first line item on current liabilities is financial liabilities. This is further divided into 3 different line items. Let's review few line items. Starting with borrowing. Borrowing refers to the short-term obligations of the company. This is the short-term loan usually undertaken by company to meet daily cash requirements. The next line item is trade payables. These are short-term obligations payable to the suppliers. It includes payment due for providing raw materials, finished goods, utility companies for providing services like water, electricity and so on. You can further review corresponding note in annual report to understand details of company liabilities. Before I explain equity portion of balance sheet, let's understand how company fund its operation and growth. There are 3 ways company can generate funds. First, profit generated by business itself. It can be reinvested for business expansion. Second, raising debt from banks. Third, raising equity. This means company is selling fractional ownership of its business to the public. Public can buy shares and become owner of the business in the proportion to their shareholding. In turn, company receives funds for business expansion. The money collected from the sale of shares is called as equity share capital. Now you know the equity share capital. Let's review equity side of balance sheet. Equity is broken down into 2 main components. First, equity share capital. Equity share capital is money collected from people in exchange of shares through IPO process. Second, other equity. When company makes profit, it can be used for further expansion or return to the shareholder as dividend. Other equity refers to the profit accumulated over the years on balance sheet. Next line is non-controlling interest. A non-controlling interest, sometimes referred as a minority interest. This will be discussed during understanding of consolidated financial statements. You don't see this line item on every balance sheet, but it will appear when company has holding in other companies. You can review note 13 and 14 to review further company equity share capital and other equity. I hope by this time, you developed good understanding of balance sheet. Let's re-look at balance sheet in its entirety. First, I will summarize details from previous session. In previous session I explained assets side of balance sheet. Assets side of balance sheet displays all the assets the company owns. Assets are of 2 types. Non-current assets. Current assets. Non-current assets are the assets that cannot be easily converted into cash within a year. However, current assets are more liquid and can be easily converted into cash within a year. I have also explained note to balance sheet. You can refer corresponding note in annual report and review details of assets classified as current and non-current. In this session I explained liabilities and equity side of balance sheet. Liabilities side of balance sheet displays all the liabilities and equity. Liabilities are of 2 types. Non-current liabilities. Current liabilities. Non-current liabilities represents the debt or liabilities that will become due beyond 12 months in future. However, current liabilities are due within a year. The next important component of balance sheet is equity. Equity has 2 main components. Equity share capital and other equity. Equity share capital refers to the funds collected by company through IPO process. Other equity refers to the profit accumulated over the years on balance sheet. You can refer corresponding note in annual report and review details of equity and liabilities classified as current and non-current. Let's summarize balance sheet equation now. The company's total assets should always be equal to total liabilities and equity. In other words, assets minus liabilities is equal to shareholders' equity. This is actually the net worth of the company. This represents the money belonging to shareholders. This is also called as book value of the company. Thank you.